Welcome to the Deep Dive. Today we're tackling a real cornerstone of Luxembourg's financial world, the Law of Five, August 2005, on financial collateral arrangements. You'll often hear it just called the Collateral Law.
That's right. It's fundamental.
Think of this as, well, your express route to getting your head around a law that powers so much activity, especially, for Luxembourg investment funds.
Definitely.
We've basically distilled key insights to try and make this complex area clearer for, everyone involved: lawyers, service providers, directors, finance pros.
The whole ecosystem, really.
Our goal today is simple: explore the essentials, its role, especially for those of you working with Lux funds. We're drawing on some detailed analysis to answer, the basic questions about this key law and its impact.
And it's fascinating, isn't it, how this seemingly technical law has been so instrumental in, building Luxembourg's success as a global financial hub.
Right.
The 2005 law, which brought the EU's Financial Collateral Directive into Luxembourg law, wasn't an accident. It was a very deliberate move.
To be creditor-friendly.
Exactly. To create a, let's say, business-friendly environment for both sides, lenders and borrowers, prioritizing clarity, ease of use. It was quite strategic.
Okay, let's get into the specifics then. What exactly is a financial collateral arrangement under this Luxembourg law?
So the 2005 law, it lays out three main types. First, you've got pledge agreements contre the gage.
Yeah.
Think of that like setting an asset aside as security. You still technically own it, but it's pledged.
Got it.
Second, there are title transfer arrangements. That includes the contrat de transfert de propriété à titre de garantie and also the fiducie sûreté.
Right, the security trust idea.
Precisely. Here, ownership actually temporarily transfers to the lender as security.
A bit different.
And third, repurchase agreements, or contrat de mise en pension. Essentially, selling an asset with a promise to buy it back. So it's quite a flexible framework covering different security methods.
So why should our listeners, busy professionals, really care about these different types? What makes the collateral law itself so significant?
Well, connecting back to that bigger picture, its importance really lies in that strategic role, positioning Luxembourg
as a major financial center.
Exactly. Luxembourg deliberately went for a very creditor-friendly approach when implementing the EU directive. The goal was maximum legal certainty.
Makes sense.
Operational flexibility, strong protection for collateral takers. It was all designed to simplify things, cut transaction costs, and, importantly, reduce systemic risk.
By making defaults less messy.
Pretty much. And crucially, the Luxembourg courts have consistently backed this framework up. That reinforces its reliability, you see.
Okay, reliable framework, creditor-friendly. So who are the players? Who typically uses these arrangements, especially when we're talking about funds?
Well, the law's scope is intentionally broad. It doesn't really matter if the parties are commercial entities or not.
Okay.
But yeah, in fund financing, you very often see credit institutions, investment firms, insurance companies, and of course, the funds themselves.
UCIs, AIFs.
Both. UCIs and AIFs, their management companies, central counterparties, settlement agents, public sector bodies, various corporates, too.
It's a wide net.
It is. And interestingly, amendments in 2022 specifically confirmed that payment institutions and electronic money institutions can act as fiduciaries in those security trusts, the fiducie sûreté.
Ah, okay. So the scope keeps adapting slightly.
It does.
We've covered the who. Now, what about the what? What kinds of assets these avoirs can actually be used as collateral?
Right, avoirs. It basically breaks down into two main categories: financial instruments and cash claims.
Okay.
Financial instruments is defined broadly, referencing Luxembourg's main financial sector law. So it includes the usual suspects: shares, bonds, other debt instruments, negotiable securities.
Units and funds.
Yes, units and UCIs, money market instruments, and any sort of related claims or rights. And these can be held in different forms, too.
Like?
Bearer form, where holding it means you own it, or registered form, recorded by the issuer, or very commonly now, book entry form, held electronically.
And cash claims.
Simpler. Just claims for money repayment. Think bank deposits, maybe loan proceeds waiting to be dispersed.
Has this list of eligible assets changed much over time?
Oh, definitely. It's adapted. Like you mentioned, fund units, the law of July 2022 explicitly confirmed UCI units and also insurance contracts as eligible, which is obviously huge for the fund sector.
And did it say how to enforce over those?
It did, yeah. It even specified particular enforcement methods for them. And looking even more recently, there's the blockchain 4V law.
Ah, The DLT stuff.
Exactly. Effective end of 2024, it amended the collateral law to expressly allow financial instruments issued or registered using DLT tokenized securities, basically to be used as collateral.
So keeping pace with innovation.
Trying to, yes.
Okay, assets covered.
Mhm.
What about the debts or obligations being secure? What kind of financial obligations fall under the law?
Here again, it's flexible. It applies to obligations to pay money or deliver financial instruments.
Present debts, future debts.
Both. Present or future, actual or contingent. So quite broad. And importantly, the obligation being secured doesn't have to be the collateral provider's own direct debt.
How does that work?
Well, a fund, for example, could give collateral to secure the obligations of, say, its investment manager or maybe another group company.
Okay, useful structure.
And these arrangements can also be set up in favor of a security agent or a trustee who then holds the security for the benefit of the actual lenders.
Right, common in syndicated loans.
Very common.
Okay, now let's talk about making these things legally stick. What are the key steps for perfection? How do you make it work?
This is where the law really aims for efficiency. The main requirements are pretty straightforward. You need written evidence of the agreement.
A contract, basically.
Yes, a written agreement. And what's called dispossession, which essentially means transferring possession or control over the collateral to the secured party.
So the lender gets some form of control.
Exactly. The written evidence just needs to clearly identify the collateral. And importantly, you generally don't need formal registration, like in some other systems.
No central registry.
Not typically for the collateral agreement itself. Now, how you achieve that dispossession or control, that varies.
Depends on the asset.
Right. For book entry instruments, it's usually done by crediting them to the collateral taker's account, or maybe registering the pledge in the securities settlement system.
Okay, and cash. Like money in a bank account.
For cash claims, it's often established just by the agreement itself. Sometimes you might need notifications to the bank holding the account or specific control agreements.
What about old school physical things? Bearer bonds.
Physical delivery. Simple as that.
And registered shares, not in book entry.
That might involve registering the pledge with the issuer or perhaps delivering endorsed share certificates. The law is quite practical there. It even allows all assets pledges.
Pledging everything.
Potentially, yes, provided you can meet that dispossession or control requirement for each type of asset involved.
Okay, that covers setting it up. But what if things go wrong? If the obligations aren't met? How does the lender, the collateral taker, enforce their security?
Right, enforcement. This is another major plus point of the collateral law for lenders. It's designed for efficiency and flexibility.
Meaning quick. No courts needed.
Often, yes. Unless the parties specifically agreed otherwise in their contract, the collateral taker can usually enforce without giving prior notice and without needing a court order first.
That's powerful.
It is. And remember, we mentioned the 2022 law. It reinforced the freedom parties have to define what an enforcement event is.
So it's not just failure to pay.
Exactly. It could be breaching financial covenants, cross defaults, other things defined in the agreement. When an event happens, the law offers several ways to enforce.
Like what?
One key method is appropriation. The collateral taker basically takes ownership of the asset.
How's it valued?
Usually agreed in the contract. But the 2022 law gave guidance for UCI units. Use the last NAV if it's not more than a year old, or the current redemption value.
Okay, appropriation. What else?
Sale. This can be a private sale as long as it's on commercially reasonable terms.
Or public.
Or sale on a trading venue. And the definition of trading venue was updated in 2022, includes regulated markets, MTFs, OTFs, more modern.
Right.
There's also public auction. The 2022 reforms streamlined this too. The collateral taker can appoint a notary or bailiff. No need to involve the Lux Stock Exchange automatically anymore.
More control for the lender.
Yes. Then there's netting, or closeout netting. Very important for derivatives. It lets parties accelerate and net off mutual obligations when an enforcement event happens.
And the courts.
There is judicial allocation getting a court order to transfer the asset, but it's less common because the other methods are usually faster.
Okay. And you mentioned specific methods for certain assets earlier.
Right. The 2022 law codified some common practices. Like for UCI units, you can enforce by directly redeeming them from the fund.
Thanks, Seth.
And for insurance contracts, you could exercise rights under the policy, like claiming the surrender value.
Very practical. Now, a term you hear constantly with this law is insolvency remoteness. What does that actually mean in practice?
Ah, yes, this is absolutely critical. It's a huge draw. It provides a significant safe harbor,
Meaning?
meaning that these collateral arrangements and the ability to enforce them using those methods we just discussed remain valid and effective even if the collateral provider goes insolvent, liquidation, bankruptcy, etc.
So the lender is protected from the usual insolvency mess.
Mm-hmm.
Clawbacks, freezes.
Generally, yes. They're protected against typical clawback rules by liquidators, and automatic stays or freezes on enforcement usually don't apply to these arrangements.
Wow. Now, wasn't there some debate about whether this applied globally?
There was, yes. A bit of uncertainty in early 2024. A Court of Appeal decision suggested the protection might only cover insolvency proceedings within the European Economic Area.
That would have been a big deal.
Huge. But the Luxembourg legislator reacted very quickly. A law in July 2024 clarified that foreign proceedings means any insolvency proceedings outside Luxembourg.
So global reach confirmed by law.
Confirmed by law. And then, crucially, the Supreme Court, the Cour de Cassation, definitively confirmed this in December 2024. The safe harbor has global application. Full stop.
Okay, so that uncertainty is resolved now.
Resolved. Crystal clear. It's a global protection.
And how does this interact with Luxembourg's newer restructuring law, the one from August 2023?
Good question. The 2023 Preventive Restructuring Law explicitly carves out financial collateral arrangements under the 2005 law. They remain enforceable even during restructuring proceedings.
So the collateral law kind of trumps the restructuring stay.
In effect, yes, for these specific arrangements. One practical tip, though. Check your enforcement triggers. If your only trigger is, say, an acceleration of the debt, and that acceleration gets temporarily stayed by the restructuring court, you might have a practical delay. Better to have other triggers, too.
Got it. So pulling this all together, how does it directly impact investment funds, AIFs specifically operating in Luxembourg?
It's absolutely fundamental, especially for how AIFs get financing. Think about subscription line financing.
Capital call facilities.
Exactly. Funds pledge the investors' uncalled capital commitments as security for credit lines. This lets them make investments quickly without waiting for capital calls. The collateral law makes this work smoothly.
And NAV facilities.
Same thing, net asset value facilities or asset-backed lending. Here, the fund pledges its actual investment portfolio shares, bonds, claims as collateral. Again, the efficiency, the enforcement speed, the insolvency protection. It makes lenders comfortable providing this finance.
And this applies across different fund types.
Yes, UCIDs, Part 2 funds, SIFs, SICARs, RAIFs, other AIFs. The collateral law framework underpins financing for pretty much all Luxembourg fund structures.
What are some practical points funds need to think about when setting these up? Documentation, service providers?
Good point. It's not just about the collateral law in isolation. You absolutely need to check the fund's own documents, the LPA, the article.
To make sure the fund can borrow and grant security.
Precisely. What approvals are needed, any limitations. Then there's the depositary.
Their role in safekeeping assets.
Right. Since they hold the assets, they generally need to be notified of pledges over those assets. They might need to acknowledge it, maybe even consent, depending on the setup. CSSF guidance is relevant there too.
And the ManCo or AIFM.
They're key too. They manage the fund, so they'll usually need to approve the financing and the security. Plus, they have reporting duties to the CSSF about the fund's leverage and activities.
Anything else? Corporate benefit.
Yes, that's a general Luxembourg company law point. Any security granted by a fund entity has to be in its overall corporate interest. Can't just be for someone else's benefit without the fund getting something out of it.
And CSSF oversight. You mentioned reporting.
Yes, the CSSF keeps an eye on things. A very specific recent example is CSSF Circular 24853 from early 2024.
What does that say?
It requires the fund's auditor, the REA, to report specifically on how entities handle client financial instruments and funds, assessing if arrangements under Article 13.4 of the collateral law are adequate.
Article 13.4. That's the title transfer part.
Exactly, title transfer fiducie sûreté. So, direct regulatory focus on collateral law compliance for entities holding fund assets. And of course, the CSSF looks at this through other lenses to AIFM rules, depository functions, AML-CFT, market conduct.
It connects to everything.
It really does.
Okay, so finally, let's look right up to date. As of today, Tuesday, May 6th, 2025, what are the key recent developments people should have on their radar?
Well, we've touched on most of the big legislative ones. The 2022 law modernized enforcement and clarified asset scope.
UCI units, insurance.
Right. The July 2024 law cemented the global insolvency safe harbor.
Crucial clarification.
And the blockchain 4B law, effective end of 2024, brought DLT-based instruments formally into scope.
Keeping up with tech.
Then judicially, the big one was the Supreme Court in December 2024, confirming that global insolvency protection. That really settled things.
And the restructuring law interaction.
Also clarified the collateral law's enforcement rights generally remain intact during restructuring. Courts have also affirmed retroactive application in certain specific contexts, reinforcing predictability.
And looking forward, the regulatory climate.
Well, the CSSF has clear priorities. Digital operational resilience, DORA, is huge. AML-CFT is always high on the agenda. Sustainable finance, ESG.
We're everywhere now.
Indeed. And the impact of technology, data, AI.
Yeah.
At the EU level, you've got AIFMD2 rolling out, MiCA for crypto assets, the AI Act, lots happening that indirectly affects the environment the collateral law operates in.
And industry bodies, ALFI, LPEA.
They continue to be important, yeah. ALFI, LPEA, ABL for the banks. They help shape market practice and provide guidance on how to apply these rules day to day.
So wrapping this up then, it sounds like the Luxembourg collateral law is, well, incredibly robust, but also quite dynamic.
Absolutely. I mean, its key strengths are clear. That legal certainty, the creditor-friendly approach, the globally confirmed insolvency remoteness, that's huge flexibility, efficient enforcement.
Can't argue with that.
It's just undeniably a cornerstone for financing in Luxembourg, and particularly vital for the whole alternative investment fund industry.
And definitely something for our listeners to keep watching, especially with, as you said, digital assets evolving, ESG becoming more integrated, DORA demanding operational changes, and ongoing EU tweaks. It's never static.
Never static. The practical application will keep evolving.
A fascinating area. Thank you so much for walking us through that complex landscape today.
My pleasure. Good talking about it.
And if you, our listeners, found this deep dive valuable, please do subscribe. That way you won't miss our future explorations of the Luxembourg financial world. This has been the Luxembourg Fundcast.